In two big episodes during the past 100 years, Germany has been at the receiving end of huge bouts of US monetary inflation. These have been quite different in nature. Each episode has finished in a German-centric shock to Europe, and in fact to the whole world. These two episodes are the late 1920s and the 1970s, the first being much more malign in its consequences than the second. Today, I would like to suggest to you that we are in the midst of a third such episode, unleashed by the US monetary response to the pandemic. This is likely to culminate in a third German shock in Europe, most likely involving the end of the present monetary union, amongst other consequences. But that's jumping ahead of our tale. I want to place this analysis of Germany, Europe, and the United States monetary hegemony in the context of our just published book, Europe's Century of Crises, under Dollar Hegemony, a dialogue on the global tyranny of unsound money, written jointly with Philippe Simonnot and myself. The book's origins lie in Philippe Simonnot approaching me 2 years ago, saying that he would like to introduce my ideas to the French public, so long deprived, in his view, of hearing the counter case to the consensus neo-Keynesian analysis which predominates there, as elsewhere. We started a dialogue, all in written form, him asking me the questions in French, and myself answering them in English. After a year, we thought of using this dialogue as the basis for a book, and Tula Weiss, the New York editor of Palgrave Macmillan, embraced the idea. The title came far into the writing process. Perhaps that's always the right sequencing. But let's start with the subtitle, The Global Tyranny of Unsound Money. Philippe and I view the monetary regime globally as highly unsound, more so now, in fact, than at any time since the collapse of the gold standard during World War I. What do we mean by unsound? It's easiest to define unsound by its opposite. In a sound money regime, automatic mechanisms guide the production of high-quality money, defined by its excellence as a store of value and medium of exchange. This occurs secure from intervention by government. Crucially, interest rates under a sound money regime are determined freely in the market with no state manipulation, and there is no price level or inflation targeting. What we see today is the complete opposite of this. There are no automatic mechanisms, and the whole machinery of money has become subservient to government-mandated purposes, whether crucially collecting revenues, holding down the cost of its borrowing in various ways, so-called economic stimulus, and of course, crucially in recent years, pump priming a hopefully election-winning asset market boom. Where is the tyranny? Unsound money sometimes directly enables tyranny. Other times it fosters disastrous economic consequences which bring about tyranny. History and the present give us examples of both. History, one thinks of the Weimar Republic, credit boom and bust. More recently, we've had the economic failure of the past 2 decades, and now the enforced lockdowns of the pandemic. There's also the enabling of the Chinese dictatorship, which unsound money around the globe, led by the US, has achieved. Switching to the main title, Europe's Crisis under Dollar Hegemony. Hegemony means different things to different people, including different economists. But here in our book, it refers to the power of one country to influence monetary conditions in other countries. The US has had that power since the aftermath of World War I. In the 100 years since the US abused this power by spreading monetary inflation around the world. By contrast, if the US had used its power of monetary hegemon to spread sound money, both it and the rest of the world would have gained substantially. that's the central contention of our dialogue. But enough of the introduction, let's move on to the discussion between myself and Stephen Martus, my co-founding partner at Macro Hedge Advisors, our consulting firm in London. Just before doing that, I wish to acknowledge the tremendous support for my research and development of my ideas from the Hudson Institute, especially from Joel Scanlon.
Brendan, many people, when they think about inflation, focus on the CPI, and they would observe that in the past decade, for example, this has been lower than preceding decades. Yet, you say in the book, the monetary inflation and its consequences have been severe during this period. Could you please explain this?
Well, monetary inflation transcends CPI measurement. It's much broader than that. And there's two key aspects to monetary inflation. First is the symptom of asset inflation, of which the main characteristic is high degree of irrationality. And the second aspect is goods and services inflation. But when we consider goods and services inflation in monetary terms, it's not measured directly by the CPI, because if we consider a sound money regime, for many years you could have prices falling and many years prices rising, depending on what the pace of productivity changes are, what the degree of globalization is occurring. And so when you look at a period of strong monetary inflation, if that actually coincides with a period when there's downward pressure on prices due to non-monetary factors, you wouldn't be seeing much inflation on the CPI. And that indeed has been the situation for the last 2 or 3 decades, where there's been tremendous globalization, technological change, which under sound money conditions would have been bringing prices down, but central banks, by their monetary interventions, have actually achieved a significantly positive rate of inflation. So in sum, CPI is not a good indicator by any means of monetary inflation.
Asset inflation, malinvestment, speculative narratives, deflation phobia. These are some of the most used terms according to the book's index. Brendan, maybe you could give us a flavor for these terms.
Well, asset inflation, a key component of monetary inflation, has as its main characteristic irrational behavior driven by yield seeking. Because central banks have kept rates so low, or negative in some cases, this drives a desperation for yield amongst income-famine investors. And in their desperation, they bring about price changes of asset markets, in particular sectors of the asset markets, which make very little rational sense. So you get, as a result of these mal signals, a lot of investment taking place, which essentially is malinvestment. It wouldn't have taken place. Other investment would have taken place instead if the price signaling in asset markets had been efficient and not corrupted. Now, one aspect of asset inflation is the speculative narrative, because under these conditions of income famine, where investors are desperate for yield, they begin to convince themselves of the truth of narratives, speculative narratives, which in monetary normal times, that is sound money times, they would be highly skeptical of. At any time, Arthur Miller is right in saying that in the markets, if it's Wednesday and enough people think it's Thursday, then it's Thursday. But generally, if rationality is strong, those sort of distortions are pretty fleeting. But under conditions of asset inflation, these distortions can become embedded and last a long time. Now, the final term you mentioned as often being in the index to our book is deflation phobia. What I have in mind here is central banks preaching to us that deflation is generally bad and results in loss of economic prosperity. And so it's worth trying to target an inflation rate which is significantly positive, 2% plus, to provide a cushion against entering this dangerous deflation zone. In fact, the complete opposite is true. If we look at the periods of strongest growth and prosperity, historically, there have been when productivity growth and globalization are running high, and under sound money regimes, prices have been falling. And one thinks of the period of maximum growth, for example, in the United States in the 1880s.
Brendan, much of this book is a discussion of international monetary history in the past century, and especially the role of Europe in this. Here are some of the positions you take in the dialogue, which I find counter to the standard historical treatment. First, the US was already the monetary hegemon from 1920 and was already an inflationary hegemon. The key relationship here was with respect to Germany. Could you please comment briefly?
Well, in the standard history books, if these are actually to be found, you would find the story that before 1914, Great Britain was the monetary hegemon, the leader of the orchestra in Keynes' terms. And then in the interwar period, the 1920s and 30s, you had a dual hegemony of both Great Britain and the United States. And again, if you read Milton Friedman and Anna Schwarz's Monetary History of the United States, they portray the Federal Reserve at that time as being highly benign with generally stable. What we suggest in this book instead is that the US emerged from the First World War as the undisputed monetary hegemon. And it achieved that power because during the war, Britain and France essentially commandeered the gold backing to their currencies, whether from the banks or from private citizens, and sold that gold in the United States to finance their war expenditures. So after the war, the US had huge gold reserves way in excess of the legal minimum as established in the Federal Reserve Act, which allowed the Federal Reserve considerable scope to run discretionary monetary policy no longer bound by rules of the gold standard. And given the political reaction to the deep recession and falling prices of the Great Recession of 1920, and that reaction was particularly prominent in the US Congress, the Federal Reserve through the 1920s was on overdrive to prevent prices falling, even although this period was in fact analogous to the 1880s, a period of fantastic productivity growth in the US economy in the Second Industrial Revolution. So that by resisting that fall in prices, the Federal Reserve was essentially conducting a policy of high monetary inflation. And this showed up most of all in asset markets, where you had a tremendous bubble growing in the US equity market on Wall Street and also in the US real estate markets. Globally, the big bubble was the lending boom into Germany, where an economic miracle did unfold in the years after the emergence from the hyperinflation. And this miracle economy in Germany was accompanied by high interest rates, which drew in tremendous amount of funds from the low interest rate US dollar. And this magnified the credit bubble, which of course all ended up in the bust of 1930-31 with catastrophic political and world consequences.
The second position, Brendan, the live history of the Bretton Woods system, let's say from 1958 to 1971, again, had its core around the US-German relationship and ended when this time Germany turned against the high inflation US hegemon. Was the German strategy of defying the US hegemon flawed in any serious respects?
The Bretton Woods system had a lifetime of, if you're generous, 12 or 13 years, if you're not so generous, about 10 years, 1958 to 1968 or 1958 to 1971. And during that period, the main currency in the world, which was freely convertible and free of exchange restrictions, was the Deutschmark. All the other major European currencies and the Japanese yen were still subject to exchange restrictions. So in many senses, Germany was the country which was most under the US monetary hegemon at that time. Now, through the 1960s, as US monetary policy became more and more inflationary, showing up first of all in asset markets and ultimately in a double-digit inflation for goods and services by the end of that decade, the political resistance, popular resistance to that high inflation grew in Germany, so much so that in 1969, the Social Democratic Party swept to power under a campaign promise that Germany would revalue its Deutschmark and escape high US inflation, and in that way bring a big rise in living standards to German middle classes. The basis of breaking away from the US monetary hegemon at that time was in fact laid out by Dr. Eminger at the Bundesbank, who, as well as being a devotee of theoretical monetarism, had become an expert at its practical, or schemes for its practical application. And he saw that in breaking away from the dollar link, Germany could nonetheless have a stable monetary regime based on very strictly controlling the growth of high-powered money within the German system. And that was essentially a monetarist doctrine and its applications. Now, there were flaws in that application because for such a system to work, the demand for monetary base has to be broad and stable, and monetary base or high-powered money has to sustain important quality differences from other alternative assets. And that became less and less the case as time went on, hence the flaws in that monetary regime, which could have been corrected in various ways, but wasn't.
Third, Brendan, in one of the key dialogues in the book, you see Paul Volcker's collaboration with James Baker in the mid-1980s in the dollar devaluation vis-a-vis the Plaza Accord as a decisive turning point for the worse in the US and global monetary regime. There was an alternative course at that time which could have taken the US and the world to a sound money regime. Could you please expand on this?
Paul Volcker, of course, was appointed to head of the Federal Reserve by President Carter in late 1978 with the promise of bringing high inflation to an end, and doing that by introducing monetarism to the United States. The corollary of his success at first in achieving that was that the dollar became super strong in the foreign exchange markets by the early mid-1980s as the whole world of investors embraced the idea of a sound dollar. This became problematic politically as the second Reagan administration became concerned with its new Treasury Secretary, James Baker, that they may lose heavily in the midterm elections of 1986. So James Baker spearheaded a dollar devaluation, of which the hallmark was the Plaza Accord of autumn 1985. But in order to achieve a dollar devaluation, of course, James Baker had to have Paul Volcker on his side, because the enabler of a dollar devaluation had to be the Fed, and abandoning monetarism and going for an inflationary monetary policy. And that's exactly what Paul Volcker delivered, going back on his previous record as an inflation fighter, and indeed reverting to his original leopard spots as a devaluationist, which he had when he was the Undersecretary of the Treasury, organizing all the devaluations under the Nixon administration in the early 1970s. The result of that rebound of inflation, first of all asset inflation and then goods and services inflation, was that by the end of the 1980s, you had yet another reaction in monetary policy towards trying to bring inflation down again and deal with the asset inflation which had grown during those years. But this new counter reaction was not any longer monetarism. It was instead what one could call an econometric standard, where econometricians, taking their cue from economic theorists such as Stanley Fischer, were convinced that by clever manipulation of interest rates based on econometric equations, central banks could deliver a given rate of low inflation. The alternative course to that fork in the road would have been to say, well, look, the abandonment of the monetarism brought about high inflation and asset bubbles in the late 1980s. What about revamping a more satisfactory alternative to monetarism, and even taking gold as the basis of a new well-anchored monetary system globally? And that indeed had been the thinking in part behind President Carter's setting up of the Gold Commission late in the 1970s. But that just was not to be the case. And historically, the world has instead gone along the path of this so-called 2% inflation standard.
Fourth, Brendan, you say the euro was born out of the collapse of US monetarism. Please explain.
Well, the strengthening of the Deutschmark, which was the corollary of that dollar devaluation, came at a very different political time in Germany from the late 1960s. By the mid-1980s, we had the Christian Democrats under Helmut Kohl in power in Germany. And we know from all the financial scandals which occurred within the Kohl regime that the party finances were very short of funds at this time. And Kohl was critically dependent on contributions from the major exporters and not such major exporters, who certainly did not want a strong Deutschmark. So this combination of dollar devaluation and strong Deutschmark did give considerable wind to the turning back of Germany on a strong Deutschmark, of a hard Deutschmark, and enabled Chancellor Kohl to embark on the train with Francois Mitterrand, French president, of European Monetary Union. So that was a crucial effect of this change in US monetary behavior.
Fifth, in the book, you and Philippe Simonnot point out the deep flaws in European monetary union, how this is an unsound monetary regime. And unlike the hard Deutschmark regime, EMU is largely under the US inflationary monetary hegemon. Could you please give us a flavor of this analysis, Brendan?
Well, one of the big paradoxes of European monetary union has been that it hasn't carried out the main purpose that was billed for it at the start of protecting Europe from US monetary shock or US inflation. In fact, the opposite has been the case. Whereas the hard Deutschmark and the Bundesbank-led monetary regime did in fact protect Europe from the US inflationary hegemon. The Bundesbank in those years defied the inflationary monetary policy of the United States. Since the ECB opened its doors at the start of European Monetary Union, it in fact has very much copied every unstable inflationary move of the Federal Reserve, and indeed in some cases amplified them. And why that's happened is very much a belief at the top of the European monetary hierarchy that Europe, or a united monetary Europe, cannot survive an episode of very strong currency in Europe against the background of a very weak dollar, because that would bring such hardship to many of the countries in Europe and their exporters that it would break apart. So we are now entering a period where, again, Europe is following a US inflationary lead.
So Brennan, where do we go from here? Europe followed the US monetary hegemony degradation through 2013 to today, even more so. The pandemic came, so now we have recession coupled with supply shock. Yet in the midst of this, we have virulent asset inflation. How will this all end up?
Well, today's economic situation involves two main components. We have a recession and the end of an asset inflation, which has been particularly virulent and long-lived. Superimposed on that, we have a massive supply shock from pandemic, which in certain key respects is similar to the supply shock of a world war. And in a war where you have monetary inflation, as indeed is normally the case in war, you do have highly speculative markets and bubble markets in so-called war stocks, stocks whose profits are rising because of the huge military expenditure or other forms of change in the economy brought on by that supply shock. So in today's pandemic-struck world, the analogy is a set of pandemic industries which are doing very well out of the pandemic. And this includes big tech, of course. It includes cloud computing. It includes stay-at-home industries. It includes a number of pharmaceutical companies. And at the base of the pyramid includes selling of protective wear and face masks, analogous to in wartime the selling of uniform to the military. Now, monetary inflation has produced such a desperation for yield and concern about high inflation in the future that these pandemic stocks, driven by waves of irrational speculation, have reached very high levels, together which, alongside that, there's been this powerful narrative that the Fed has somehow solved all solvency risk. And so we've had this new deluge of global funds seeking yield into a range of high yield products. How's all this going to end? The central scenario we raise in the epilogue to our dialogue in the book is that there's no getting away from the degradation of collateral against wide expanses of assets in the credit and banking systems, and that malinvestment, which has occurred during the past decade, and maybe in many ways being amplified by what we're getting in these highly speculative areas in the pandemic economy, will bear their brunt onto the credit and banking systems and extend and deepen this recession before it's over.
So what hope is there now for sound money? You say that a sound money regime needs a firm anchor. What do you mean by that?
I think we found out from the long history, and it is a long history, it's already 20 years, of the 2% inflation target, now amplified to 2% inflation plus, that this econometric-based standard is highly flawed, creating massive asset inflation, booms and busts, even although each particular cycle may be elongated for a considerable period of time. And the way forward is to take the road which was rejected implicitly in the mid-1980s or late 1980s, and instead of this corrosive and comprehensive manipulation of interest rates and the taking over of the monetary system to pursue so-called perpetual stimulus and perpetual asset market inflation, the way forward is to re-anchor money firmly. But that does depend on identifying and creating a monetary base which is broad enough and firm enough to achieve this role. And in our book, we do explore two principal alternatives here. One, a man-made monetary base, which would include trying to deepen and widen the high-powered money monetary base based on fiat money. And a second idea based on some reborn role for gold. And that's an idea which we explore very much and favorably in the context of both Europe and the United States.
Brendan, let's get back to the starting point. Do you think the dictatorship of unsound money could fall first in Europe rather than the US? And what would be the role of Germany in that?
It's possible that the unsound money decades or half century will come to an end in Europe and Germany taking the lead first. And it's possible also this occurs in the United States. Although the two would be very much interconnected because there's a lot of cross links between the two. And we just explore those ideas in a bit more depth. It's possible, indeed our central scenario is that after the pandemic, the US will lead the world, not immediately, but after some time, into another high inflation era, which could be as bad or worse than the high inflation of the 1970s. Now, that could be the trigger to Germany, where there is still considerable favoring amongst the population for hard currency and for savings, protection of small savers. That could lead Germany to growingly reject a policy as set by the European Central Bank to stabilize the exchange rate vis-a-vis the dollar by importing high US inflation. So that could be the force which sends Germany along a path which would ultimately mean its exit from European Monetary Union and setting up a new union, possibly centric around itself and including a few small neighbors, principal of which would be Holland. The alternative path would be where high inflation returning in the United States after the pandemic creates within the United States a counterforce of sound money, which at this present time is very weak. I mean, it's very difficult to find anybody in Congress in favor of sound money anymore. So the idea that sound money is going to come back as a force in the US politically depends on views one takes as to how conservatism is going to reformulate itself in the US political system. But if that does come about, and indeed I should just mention as a parenthesis here, that high inflation is not absolutely essential to the strengthening of political forces which would back sound money. We could also think of a situation where this mother of all monetary stimuli, which has been created by the Trump, Mnuchin, Powell Fed, doesn't actually achieve its purpose of stimulating the economy, but ends up in a massive crisis and recession before we get to the recovery. That also could be something that would strengthen political forces of sound money in the US. But if for whatever reason these sound money forces do come back into the lead in the US, that could influence and probably would influence opinion inside Germany to a degree where, again, Germany might take the lead and exit from European Monetary Union in the same way as I described earlier.
And lastly, Brendan, I turn to the conclusion of your dialogue with Philippe, which is an essay he entitles "At the Heart of the World." Philippe writes, quote, "Proposal in our dialogue for a new euro, most likely launched by Germany, based on gold in the first third of the 21st century, will be considered at least at best reactionary, and at worst unrealistic and dangerous. In advance, our reply is that such criticism has a myopic view of history. The proposal is not a return to a bygone past, but a closure of the disastrous experience of the 20th century," unquote. Brendan, are you realistically hopeful that the publication of your dialogue will light this candle of idealism at such a somber time as now for free market conservatism and indeed for human freedom?
Well, Stephen, Philippe and I would not have spent the last 2 years writing this dialogue book if we didn't have some idealism about the candle of sound money being lit and getting brighter as we go forward from this very dark point for freedom and free markets in our history. And we very much believe that what's going to unfold in coming years as we go forward from this pandemic will in fact be a springboard for those forces to strengthen, which would enable there to be a renaissance of human freedom and free market capitalism. But the foundation of that has to be sound money, good money. And that's ultimately what our book is all about.
Brendan, thank you very much for the fascinating, insightful, and thought-provoking discussion today. The book is, of course, available at a discounted price. Please find the link to purchasing the book on the following slide. And thank you very much for tuning in today.